Hello, everyone. Thank you so much for joining us today. Today we have the Nest Edge for August 2022. I'm here with Sean McDougle, our portfolio manager. And so, again, let me introduce myself. My name's Gloria Park. I'm one of the advisors. I should probably do that too, right? Introduce myself. One of the advisors at Nest Financial. We host these webinars on a monthly basis so that we can inform our audience and our clients about what's really going on in markets and the economy, and also share a bit about our portfolios as well. Um, I I must also mention that this is not investment advice. So these webinars are for educational purposes only. If you do have a specific question about your own portfolio and would like some personalized advice, please reach out to us. You can reach out at info@nestfinancial.net, or give us a call. So to begin, every month Sean will write a newsletter called The Nest Edge, and bring up any type of particular topic, or actually multiple topics within what's going on in the markets and the economy. And so for this one, it is called It's a Bounce House. And he went over a slew of things. We are facing a recession, whether or not the media and the government wants to admit it, pretty much in a recession phase. And so wanted to bring on Sean to have him talk about, give a bit of a rundown on what was said in the uh, newsletter in case any of you missed it. So what's going on, Sean?
Same old, same old. Yeah, not a ton has changed. Today was a big data point that came out. Retail sales numbers was softer than expected. I hate that saying, but yeah, it stalled. It was anticipated that the retail sales numbers would have been fine. It kind of continues with that, what we've seen lately with this equities domestically, this bounce, which is very normal in bear markets and in recessions or depressions, however you want to, whatever definition you want to use. Yeah, so everything is, as of right now, equities domestically is kind of trading around what inflation is or isn't doing, and people are just kind of like putting blinders on to everything else. And when reality, like there's way bigger problems than inflation. I feel like I'm just like living in Groundhog's Day. Every day is exactly the same, and I keep saying the exact same thing. But this is going to be a slow process. This is not going to be a 2020 down and back recovery and everything's fine. I know the only thing that the media is talking about is inflation, but that's honestly that issue's yesterday's news. The better than expected inflation print that we got a few weeks ago was 8.5 instead of 9.1. That's what we expected. The difference is we don't expect it to fall off a cliff from here. It's going to stay in the mid eights. The reason it went from 9.1 to 8.5 is oil is down, God, I don't know, 30%. 30% or so. It's down 12% in the last month, 4% in the last week. So oil's gotten smoked. It's the biggest component of, commodity prices, the CRB index. So whatever oil does, oil was also a big component of what was driving it up. We don't anticipate that to be continued, the falling off a cliff that what we saw. So we think the next, few readings of inflation is just going to be hanging around in the eights. That's the most probable scenario. The inflation is going to stay sticky.
Mm-hmm.
The thing that people are just completely turning a blind eye to is just the dramatic slowdown that we're seeing economically, domestically, and abroad. Again, I touched on this with this whole depression, recession, however you want to phrase it. Like, I think that is so overhyped and made it to being a bigger deal than it really is. We're slowing. Like, you could change up the definition if it doesn't fit your political goals at the time, but we are slowing, and then we're at a faster rate. I don't know what to tell you. You don't need a recession or a depression to lose a bunch of money. So it just really is a media thing. I don't give a crap whether it fits in their square box of whether it we're slowing or not. Everything I'm looking at right now is slowing and screaming red. This is probably going to be, I guess, what I started at before this little rant. It's probably going to take us a year, 3 to 4 quarters, and we're going to probably test the lows that we had in June in domestic equities. That's the most probable scenario. Like, this storm is not over. It's going to be for different reasons, but it's going to be more similar to what we saw, in the, tech bubble 2000, 2001, and the housing crisis 2008, 2009, and then it bled into multiple years. It took a while. This is not going to be a fast recovery. 2020 super fall off a cliff recovery was unique. Don't even send me, if you're looking at this webinar, send me some article that says this year is just like 1981. I hate those. 2022 is only like 1 year, and that's 2022. Every year is unique. Every year is different. It's got different situations. So you got to read and react, play the game that's in front of you.
Sure. And during this time, we also have way more trading, like online trading that's happening. I mean, way more information and technology that's being spread faster than it has, in the past, the past 2000 tech bubble, and then 2008. Like
most trading up is machines. So that's another kicker that people don't, best estimates 60 to 70% of volume on the major exchanges in the US is machines that are just chasing momentum.
And so so we're also looking at, as you mentioned in the newsletter, what you've said already is that, looking at probably 12 to 18 months of this slowdown and just a bunch of bad news, like things not looking good. And so, I mean, I was just telling you right before this webinar, I'm like, wow, like,
I should have got a blanket and then like put it in the sink and then just worn a wet blanket this whole webinar just to stay in character.
Next time we can just like take a photo of you and add that to the header.
I'll just wear it. I don't care. We got concrete floors. I get a little wet. Ash isn't here right now.
Yeah, so things are not looking really good, but I know that you've made some changes into the portfolio, that moving everything to safety, but even that's had some hiccups. So what indicators are you looking at to make sure that clients are protected, and also that we're trying to make money and do our best during these downturn, these bad times that are coming up and that we're experiencing now?
As I mentioned, the most probable scenario is we're going to have 4 straight quarters of quad 4, which in English means slowing growth and inflation. The rate of change of those is slowing. There's certain things that do well in those environments, and there's certain things that don't do well in those environments. And it doesn't mean that you can't have bear market bounces, which is what we're experiencing right now. It's the most clear-cut bear market bounce I've ever seen in my career.
Bear trap.
Bear trap. Yeah, that's the cooler name for it. I need to. What is it called? No, when you pay for the phrase, I own the phrase. What is that called? I'm drawing a blank. Doesn't matter. I need to make t-shirts because it's just a cool saying. We are positioned very defensively, have been for a while, probably will be for a while longer. We have, across all of our models, 0 equities. There are some that are on my radar, but nothing that's intimate. So we have a lot of US dollars. We have gold, which we've actually finally bought some more today. I have been waiting and watching on gold for weeks. Yesterday, I got a good signal. Today confirmed it. So pretty much every model bought a little bit of gold today. We're basically 10% US dollars across the board and somewhere between 6 and 7% gold in all the models. And then the other one, which has been the redhead stepchild. Sorry if you're a redhead, but I have a red beard, so I can say this. Treasuries have been the bad child this year. We understand why it didn't work. It was, one of those scenarios of being wrong for all the right reasons. We understand it. We reduced our exposure probably 2 months ago, and we've let the volatility kind of shake out of there. And we're starting to see that. We were really close to buying some treasuries last week, but we were kind of nervous about this retail print that came out today. And I'm glad we didn't buy any yesterday because the retail numbers that came out today were not great. Shocker. And bonds behaved poorly today. And that's kind of how they've, there has been a pretty high correlation with what domestic equity is doing and the domestic treasuries. It's not as high as it was. It is starting to break down. But that is the position that I'm watching the most. But even then, most of our models are around 20%, 15%, 15 to 20% treasuries across multiple positions, across like 1, 2, 3, 4, 5, 6, 7. Is that 7? 3, 6, 8. 8 different ETFs. So all across the curve, the yield curve.
Duration.
Yeah.
Yeah. So
Multiple versions.
what I want to also mention is that, when Sean says, "Hey, we're in treasuries," it doesn't mean that we are just in one single ETF position, but we're touching on various. We have various treasury funds, within the portfolio.
Multiple. Yeah, we're not too heavy in any of them. We're somewhere between 2 and 4% per. And again, I'm looking to buy treasuries when it comes down, because the first 6 months of this year, treasuries was the pain in the ass. This second half of the year, they're probably going to be things that's going to make us a ton of money. So I'm not looking to get completely out of them. I'm like at my minimum position for all of these holdings, and we're kind of just going to let the market come back to us. We just need this correlation to break down even further with domestic equities and bonds, because this Looney Tune consensus feeling that the only thing that matters right now is inflation, and what the Fed's going to do is just, it's exhausting. I don't even argue with people anymore. I'm like, you're right, leave me alone. Like I don't care. My last study group get together, like half of us agree and half of us don't at all. So it's just like, even in a circle of friends and peers of mine, there's just a lot of narrative Bible chasing beliefs that just like, this is all because of inflation. Like, no, fortunately it's not. I wish it was. This would be much easier to handle. But there's a series of issues. At some point, the Fed will blink, but not yet. If you're going to put a gun to my head, I would say by the time spring rolls around, spring of 23, they're going to be cutting rates, because they're doing what they always do. They raise rates into a slowdown, exactly what they shouldn't be doing. They're very forward or backwards looking and have no imagination. Or there's something else going on that I'm not privy to, but they're just, I go off of their batting average, and their batting average is terrible.
Yeah, I mean, these past couple of years have been very different than any other time that we've ever experienced, not only in the trading world, but also we came out of a global shutdown. There's been a war to break out. I mean, of course, it's across across the globe for us, but still, any
Yep.
war in any country affects us.
It's not been boring.
Yeah,
It's not been
so
boring.
there's been a lot of things, and then with the Fed, consistently, one thing that they do consistently is run their mouths and
Oh my
raising
God.
rates.
Yeah.
They're going to raise rates here and there, and so a mixture of all of these things have caused so much volatility and a lot of uncertainty.
I
And
can't remember
so,
the guy's name. I think it was the guy from the St. Louis Fed, was on CNBC running his mouth that like that there what he was saying, there's no there's no recession. It's just, get off the damn TV. What are they doing on there? Like it blows my mind. I was like, this is not like I know what they're doing. They're interviewing for their, building the resume and interviewing for their next job. It's just like, oh my God, like you guys are a nightmare. You're your own worst enemy. You're afraid of this inflation shadow that you dismissed as transitory for how long? And now it's the biggest problem in the world. Like, I trust you to get this next move right because you screwed up the last one and the one before that and the one before that. Like, get out of here. You guys are.
so besides all of these opinions, we also have elections coming up as well. We don't ever get political, but it's something that we do keep in mind. So this is a time where people are trying to make these bold statements, whether it's in the Fed, anywhere on TV,
Yep.
to make themselves look good.
Yep.
It's not pleasant for any politician to say we're going into a recession and then having to actually be in one and deal with it. It's just not very positive in every aspect. And so I think it's important that we stick to the numbers. And so Sean is that's what he's doing. He has a
Data doesn't
process.
lie. People lie all the time. But yeah, data does not lie. I like data and numbers more than most people. At least I know what I'm going to get, and I know within reason what to expect. Yeah, there's midterms around the corner. I don't personally care. It doesn't affect the models. I'm aware of it. Our research provider has an analyst in Washington, so I hear about bills floating through Congress and dirty rumors and stuff like that. But it has no impact on like why I did or did not buy gold today. That was purely data. But yeah, it's a thing. It exists. It's part of the world, but it's not going to make a determination of whether we, the next big move that we have will be when we start buying treasuries again, and we'll see when that happens. I would love to do it, but we have tons of cash. We're looking to do it, want to do it, but I have specific things I'm waiting on to confirm. I don't want to repeat what happened at the beginning of this year because there's head fakes. This is the year of head fakes like we're seeing with this bear market bounce. Very normal. Big time short squeeze. That was the most screamingly obvious. Like this is getting into the weeds. So Gloria, tell me to shut up if I get too far in there.
Yep, I was just about to say that we're gonna move it along a little bit faster. We like to keep these webinars short.
Yeah.
So if anybody does have a question, please feel free to throw it in the chat box. Should be on your left side of the screen. But yeah, throw it in the chat box. But I do want to address a question that an audience member had brought up, which was about our wealth management. Does that involve any hard assets? And so, hard assets, I would think means like something like physical, like real estate. And the short answer is no, that we don't, have any physical or hard assets. We deal with ETFs. And then as Sean, ETFs and correct me if I'm wrong, Sean, in currencies, commodities, bonds.
Everything is, the easy answer for this guy or gal is no. Everything we're in is ETFs, individual shares. Everything's daily liquid. So liquidity is super liquid. We have no hard commodities in like real estate or physical gold. Everything with our commodity space is going to be futures based.
So in terms of in wealth management, on the investment advisory side, the part of our firm that Sean focuses on, which is managing portfolios, the answer is no. But when it comes to the other side of wealth management for us, which is financial planning, we do take hard assets into consideration, such as real estate. We have clients who are business owners who own property, real estate, and we do a lot of planning around that to make sure you're not over leveraged and that you're positioned well, and that we can plan efficiently for your retirement or any other goals you have. So in terms of hard assets in that aspect, yeah, we do manage it.
Great answer.
So wealth management for us is two aspects: one, investment management, and the other is financial planning. So I hope that answers your question.
But yeah, to kind of put a bow on it, from our perspective, the game plan's largely the same until the data changes. Dollars, gold, treasuries at some point, and a lot of cash. There's certain models that might start dipping their toes in some foreign equities. But by and large, our positioning is going to be very similar for the next few quarters, probably. I reserve the right to change my mind. And when that changes, I'll let you know. But as of right now, that is the game plan. Just, if something drastically changes in a month, don't put a gun to my head and said, I told you so. It's like, I don't have an opinion. Just like, this is not, a right or a wrong thing. It's, what is the data? What is the most probable scenario that's in front of us?
Yes. And looking at the numbers is so important. So we have these webinars on a monthly basis. And if you do have any questions or any specific topics you would like to cover, please feel free to drop us a line, send us an email. We'll love to hear from you. If you know of anybody who maybe has questions about their portfolio, we'll be happy to take a look and speak with them. After this webinar, you will also be sent a replay. So it would be great. You can share that with others as well. But it looks like we don't have any questions that are coming into the chat at this moment. Any other questions? So we will close for today and hope to see you next month. All right. Thanks,
I didn't
guys.
talk much at all. That was quiet.
You did great.
Damn
All
you.
right.
You won't believe me. Adios.
Bye-bye.